Hello, friends. If you are receiving the UK state pension in 2026 and your weekly payment has never quite matched any figure you have seen described as the maximum, that confusion is completely legitimate. There are two state pension systems running in this country at the same time. And whether you receive more than the stated ceiling or significantly less than it despite decades of national insurance contributions, both situations can be entirely correct. They can also point to an error worth checking. Today we are covering three things what the winter fuel payment rules actually say for this winter. Because many current videos are still describing an outdated policy, why individual state pension amounts vary so widely from the quoted maximums, and why a growing number of pensioners received an unexpected letter from HM Revenue and Customs this spring, even though their pension went up in April. One key number in that last section is being quoted incorrectly by most sources, and it changes the picture considerably. Quick context before we get into it. This video is for anyone in the UK who is currently receiving the state pension or approaching state pension age and wants to understand how the rules work for 2026 to 2027. The goal is to give you an accurate, plain English account of the current rules so you can make sense of your own payment and avoid the kind of misunderstandings that cost people money. Everything here comes from publicly available official information, the Department for Work and Pensions, the UK government's official website, and HM Revenue and Customs, and I will name each source as we go. This is educational content. It is not personalized financial or tax advice. And nothing here is a promise that you will receive any specific amount. Everyone's situation is different. So before any major financial or tax decision, speak to a licensed advisor who knows your full circumstances. Now let us get into it. Let us start with the winter fuel payment, because many current videos are still describing the eligibility rules from 2024 to 2025, and the change is in your favor. According to the UK government's official website, the winter fuel payment for winter 2026 to 2027 goes automatically to all eligible pensioners in England and Wales, not only those receiving pension credit. To qualify, you need to have been born on or before the 27th of June, 1960, and be ordinarily resident in England or Wales during the qualifying week, which runs from the 21st to the 27th of September, 2026. That is the complete eligibility test. There is no pension credit requirement for this winter's payment. If you are eligible by birth date and residency, the payment arrives automatically, and you do not need to take any action to receive it. The amounts, confirmed by the Department for Work and Pensions, are £200 for those aged 66 to 79, and £300 for those aged 80 or over, depending on living arrangements. One income threshold applies if your individual annual income is above £35,000. HM Revenue and Customs will recover the payment through your PAYE tax code or your self-assessment return after the fact. That threshold is assessed individually, not as a household. So a couple is assessed separately. The vast majority of pensioners fall well below it. Pension credit is a separate question from the winter fuel payment, and still a very valuable one. The Department for Work and Pensions has estimated that around 800,000 households eligible for pension credit are not currently claiming it. Pension credit for 2026 to 2027 tops up your weekly income to £238 if you are single, or £363.25 if you are a couple. Both figures were confirmed by the Department for Work and Pensions from April 2026 and have risen considerably from what older sources. Quote, if your income from all sources falls below those thresholds, the free pension credit calculator on the UK government's official website gives you a quick first answer. Claiming pension credit unlocks support with housing costs, council tax, and NHS dental treatment real value beyond the top-up. But pension credit is no longer a condition of receiving the winter fuel payment this winter. Those two questions need to be answered separately. Now, for the question that appears more often than any other in discussions about the state pension, Why does your payment not match the figure any video describes as the maximum? The situation that illustrates this most clearly belongs to an illustrative composite, not a real individual, but a pattern that reflects the experience of many people in exactly this position. Brian is 68. A former local government worker from the East Midlands, he reached state pension age in 2021 with 40 qualifying years on his national insurance record. He expected the full new state pension. His award letter showed £196 per week. He used the government's Check Your State Pension service, a free tool on the UK government's official website that shows your national insurance record, your qualifying years, your forecast, and any gaps, and found the explanation. His local authority employer had contracted him out of the state earnings-related pension scheme through the council's occupational pension scheme in the 1980s and 90s. That arrangement reduced his new state pension starting figure, but came with a compensating occupational pension. He also found 2 fillable national insurance gaps from his self-employment years. After checking with the Future Pension Center, he paid voluntary contributions and boosted his state pension by approximately £11 per week from the following April, more than £570 per year. That is an illustrative composite. But the situation it describes is real and common. If you have used the government's Check Your State Pension service and found something unexpected, tell us in the comments. Those questions help others in the same position. Here is why the confusion about amounts exists. In April 2016, the government introduced the new state pension for anyone reaching state pension age on or after the 6th of April. 2016, according to the Department for Work and Pensions, the full new state pension for 2026 to 2027 is £241.30 per week. You reach that amount by having 35 or more qualifying years without having contracted out of the state earnings-related pension scheme. Contracting out reduces the starting figure. Fewer than 35 qualifying years reduces it proportionally. But here is what many videos leave out. If you reached state pension age before April 2016, your pension is calculated under the old system. You receive the basic state pension up to £184.90 per week, plus any additional state pension, sometimes called SERPs or the state second pension, that you built up during your working life. For someone who spent decades in full national insurance contributing employment, that additional state pension element can push the total well above the new state pension ceiling. And this is entirely legitimate. There is also a transitional protection worth knowing if you reached state pension age on or after April 2016, but your old rule's entitlement would have been higher than the new ceiling. You receive what the Department for Work and Pensions calls a protected payment, a top-up, preserving your previous entitlement. This is another reason why some post-2016 retirees receive amounts above the stated maximum. The only reliable starting point is the government's Check Your State Pension service, which shows your record in full. If you find gaps, contact the Future Pension Center before paying anything. Not every gap is worth filling. And the Future Pension Center can work out whether voluntary contributions make financial sense for your situation. One more group worth addressing directly: anyone who took time out of employment to care for a child or a dependent adult. Carers credits registered with HM Revenue and Customs can count toward your qualifying years for those periods without any payment required. Many people, particularly women who took career breaks, have national insurance gaps that carers credits could fill at no cost. If that fits your history, it is worth checking before assuming your amount is fixed. Now for the thing catching the most people off guard this spring. The full new state pension for 2026 to 2027 is £12,547.60 per year, confirmed by the Department for Work and Pensions. The personal allowance, confirmed by HM Revenue and Customs, is £12,570, frozen at that figure since 2021. The gap between those two numbers is £22.40 per year, not £2,240, as a number of current sources are stating, £22.40 per year. smaller than a typical weekly grocery shop. If your only income is the state pension, you remain just below the personal allowance. But if you have any other income on top, a workplace pension, modest savings, interest, even part-time earnings, your total is above the threshold, and some of it becomes taxable. The state pension is paid in full by the Department for Work and Pensions without tax deducted at source. HM Revenue and Customs collects the tax separately, either by adjusting your PAYE tax code if you have another income source, or through what is called a simple assessment. A simple assessment is a letter from HM Revenue and Customs stating the income tax owed for the previous tax year. It is not a scam. It is not a mistake. It is the mechanism through which HMRC collects tax from people whose income exceeds the personal allowance but who do not file a self-assessment tax return. If you receive one, read it carefully. You can pay the amount stated by the deadline the 31st of January following the end of the relevant tax year. If you believe the figure is wrong, you have 60 days from the date of the letter to contact HM Revenue and Customs and request a review. The genuine HMRC contact details are listed on the UK government's official website. Do not use any contact details from unofficial sources. Scams impersonating HMRC are active. And the genuine simple assessment process does not involve unsolicited calls requesting payment. The triple lock delivered a 4.8% rise. In April 2026, then weeks later, an unexpected letter arrived for a growing number of pensioners. The two events feel disconnected. They are not. The rise moved more people's total income above the personal allowance. And the simple assessment is the tax system responding. For those close to the threshold, it does reduce the net benefit of the April increase. If you received a simple assessment letter this year and found it confusing, you are not alone. And saying so in the comments may help others in the same position. So here is where things stand. The winter fuel payment this winter reaches all eligible pensioners automatically born on or before the 27th of June 1960 in England or Wales, with individual income under £35,000. During the qualifying week of the 21st to the 27th of September 2026, pension credit confirmed at £238 per week for a single person and £363.25 for a couple by the Department for Work and Pensions, is worth checking in its own right for anyone whose income falls below those thresholds. Your state pension amount reflects your own national insurance record, and which system applies, use the government's Check Your State Pension service if your amount has ever surprised you. And if the April rise pushed your total income above the personal allowance, a letter from HM Revenue and Customs is the expected and legitimate result, with a clear response process attached. 3 actions from today. First, use the Check Your State Pension service on the UK government's official website. Look at your national insurance record and qualifying years, not just the forecast figure, and check for any gaps. Second, if your total weekly income falls below £238 as a single person, or below £363.25 as a couple, use the free pension credit calculator on the same website to check your eligibility. Third, if you have any income beyond the state pension, or if a simple assessment letter has arrived and the figure does not look right. Speak with a licensed tax or financial advisor who knows your full picture before deciding how to respond. If someone you know is on the state pension and unsure about any of this, please share this before September. The qualifying week is close. And if you want the full picture on filling older national insurance gaps, including a deadline that applies to gaps going back further than the standard 6 years, which changed in 2025, that is covered in the linked video below.